Capital flight. Latest news. India is witnessing significant capital outflows and depreciatory pressures on the rupee amid rising oil prices and the West Asia conflict, raising concerns about the country's external sector stability. Understanding capital flight and currency depreciation. Capital flight refers to the large-scale movement of financial assets and capital out of a country, typically triggered by economic instability, geopolitical uncertainty, or unfavorable monetary conditions. It often results in currency depreciation, weakening of foreign exchange reserves, and pressure on the domestic economy. Currency depreciation occurs when the value of a country's currency falls relative to other currencies. In India's case, the rupee has been weakening against major currencies like the US dollar due to a combination of outflows of foreign capital, rising imports, and global uncertainty. How capital flows affect emerging economies. Emerging market economies like India typically offer higher returns on investments compared to developed economies, attracting foreign capital. However, they also carry currency and inflation risks. A rise in Indian inflation or a depreciation of the rupee can reduce the net return for foreign investors, making Indian assets less attractive. The decision of foreign investors to hold Indian assets depends largely on the interest rate differential between India and developed economies, particularly the US. If interest rates rise abroad, foreign investors tend to withdraw from Indian markets, leading to capital outflows from emerging markets. Depreciation of the rupee as investors exchange Indian assets for dollars. Pressure on the RBI to either raise interest rates or impose capital controls. Lessons from the 2013 taper tantrum. The current situation echoes the 2013 taper tantrum, when the U.S. Federal Reserve announced a possible end to its quantitative easing program. Even before any actual rate hike, the mere expectation of higher U.S. interest rates triggered massive capital outflows from emerging market economies, including India. The episode demonstrated that expectations alone can drive capital flight, making emerging economies particularly vulnerable to shifts in global monetary policy sentiment. Current scenario: West Asia conflict and capital outflows. The outbreak of hostilities in the Persian Gulf and the closure of the Strait of Hormuz have caused significant disruption to global energy markets. India, which imports nearly 85% of its crude oil, is particularly vulnerable to these developments. Key observations. Foreign capital outflows have intensified despite no change in US or UK interest rates. The US Federal Reserve and the Bank of England have maintained interest rates at 3.75% since December 2025. Central banks initially forecast that the oil price spike would be temporary, making rate hikes unnecessary. However, prolonged conflict raises the possibility of persistent inflation, which could force future interest rate hikes. Why this time is different. What makes the current scenario particularly worrying is that capital flight has occurred even without any definitive signal from foreign central banks about raising interest rates. This suggests foreign investors may have already priced in future rate hikes. Markets are responding to profound global uncertainty rather than confirmed policy shifts. If interest rates do rise abroad, India could face additional pressure on its external sector. Impact on the Indian economy. Widening current account deficit. The current account deficit, CAD, is widening due to rising crude oil prices and elevated import bills. Crude oil prices have remained above $100 per barrel, significantly increasing India's import expenditure. Pressure on the rupee. The rupee has witnessed considerable depreciation in recent weeks. Combined with capital outflows, this puts significant pressure on India's external balance and foreign exchange reserves. Inflationary pressures. Rising LPG and petrol prices have caused hardships for working-class households, even triggering reverse migration of workers back to villages. Higher energy prices feed into inflationary expectations, potentially affecting wages and broader price levels. Monetary policy dilemma. The RBI faces a difficult choice. Raising interest rates to defend the rupee and prevent further capital outflows, but at the cost of slowing domestic investment. Maintaining current rates to support growth, but risking continued depreciation and inflation. Imposing capital controls, which could deter long-term foreign investment. Government and RBI response. The government and RBI have undertaken several measures to address these challenges. RBI intervention. The Reserve Bank has imposed restrictions on certain foreign exchange derivative contracts to curb speculative pressure on the rupee. Import duties on gold. The government has announced higher import duties on gold to reduce non-essential imports and conserve forex reserves. Prime Minister's austerity appeal. PM Narendra Modi has urged citizens to reduce consumption of gold and petrol, encouraging the use of public transport, electric vehicles, and locally manufactured goods. Structural vulnerabilities. India's external sector faces several structural challenges. High import dependence on crude oil, gold, and electronics. Limited export competitiveness in manufacturing compared to peers like Vietnam and Bangladesh. Exposure to global monetary policy shifts, particularly U.S. Federal Reserve decisions. Geopolitical risks in key trade routes such as the Strait of Hormuz. Volatile capital flows that respond quickly to global uncertainty. If interest rates were to rise in developed economies in the coming months, these vulnerabilities would come under further stress. Way forward. Short-term measures. Strengthening forex reserves through targeted interventions. Diversifying crude oil sources to reduce dependence on West Asian supplies. Encouraging gold monetization to channel idle household gold into the formal economy. Promoting domestic tourism to retain forex outflows from foreign travel. Long-term reforms. Boosting manufacturing exports through schemes like PLI and Make in India. Accelerating the renewable energy transition to reduce crude oil dependence. Deepening financial markets to attract stable long-term capital. Building strategic petroleum reserves to cushion against supply shocks. Enhancing competitiveness through structural reforms in labor, land, and capital markets.